Today, the markets are digesting fresh signals from the Fed, China stimulus efforts and US chip policy shifts with implications across currencies, equities and commodities as well. Joining us today is analyst David Scutt from StoneX. David, thanks for your time. What were the key changes in the Fed's latest statement? And of course, how did the markets react?
G'day, Mike. Great to be back. The key changes, there were a few changes in the statement, but nothing that you would go and expect out of the ordinary. The Fed acknowledged that the decline in GDP that was seen in the first quarter of the year was more a function of what was happening when it came to front loading of imports into the United States ahead of those tariffs. And they also talked about uncertainty had increased. Well, duh, everyone knows that. And then talked about the risk potentially of inflation and both unemployment rising at the same time had also increased, which is very much a stagflationary environment. Again, nothing really new. So how do the markets go and digest it? Well, the market I like to go and look to immediately is the Fed funds futures curve, which basically is an assessment as to how much easing will come through from the Fed this year. And it was almost unchanged. We only saw a very, very, very minor move, and we still have 3 rate cuts priced this year, which at this point in time looks a little bit punchy.
Okay, David, let's expand on that a bit further. How did the Fed's tone and the updated rate path impact major currency pairs as well?
In this meeting, there was no new projections that were released, so it was all coming down to what the statement went and conveyed, and then also what Jerome Powell said during his press conference. And he talked it up. He talked the economy up, saying that still there's nothing really there that's concerning them. He did acknowledge that if there was to be a deterioration in the labour market, then of course the Fed will be ready to go and act and start cutting interest rates. But that's simply not being seen at this point in time. He said that they've got plenty of time to go and move, and there's no real cost to being patient at this point in time. So again, it points to the likelihood that potentially, unless we see some really sure deterioration in hard economic data in the United States over the next month or so, the Fed's going to be on hold probably again in June, and then it comes down to July. We'll get a couple more data releases coming out, including jobs reports. That will be the key meeting to focus on right now.
Yeah, well said. Let's turn our attention to the informal talks between China and the US. Could the unannounced meetings in Switzerland signal progress despite Donald Trump's tariff stance at the moment?
Look, the fact that they're talking is undoubtedly a good piece of news, but where is it going to go to? That's the other key thing. Donald Trump made it very clear last night, was asked directly, will you go and cut tariff rates ahead of this meeting to go and try and get the ball rolling? And he said no. So Chinese side has made it very clear that they want to act with sincerity to the US side of the negotiations. And at this point in time, that doesn't seem to be met the criteria. So it could be a very short and sweet meeting. Plenty of good things to go and do in Switzerland, of course. But I'm not holding a lot of hopes up, I've got to say, at least in the interim, that there's going to be something more concrete coming through from it, at least at this point. There hasn't really been enough pain, I think, on either side to really go and get them to come together. I think that will take a couple of months' time. So, look, it's good news they're talking, but don't hold your hopes up too much that we're going to get something big coming out of this meeting.
Yeah, 100%. So is Beijing losing credibility with markets after another underwhelming stimulus rollout, a band-aid solution at best, perhaps?
Yeah, there was a really abrupt announcement that came out on Tuesday saying that there was going to be a meeting coming through with regulators, including from the PBOC, China's central bank. And then they announced that they're going to go and cut the 7-day reverse repo rate, which is their key benchmark short-term interest rate to financial institutions. And they went and delivered a 50 basis point cut to the reserve requirement ratio, which is essentially the amount of cash that banks need to go and keep on hand. So that's going to go and unleash some liquidity around about 1 trillion yuan, around about probably close to 200 billion Aussie dollars. Sounds like a lot, but in an economy like China, it's not a lot. And the market saw this. There was a few other bits and pieces that were put out there, but nothing really meaningfully to go and boost the demand side of the equation. And you can see the aftermath. Aussie dollar, Kiwi dollar down really sharply overnight. We've seen big reverses coming through in commodity prices, iron ore, energy prices. So the markets think it's a wet lettuce leaf, and I tend to agree with them.
Good point. So the ASX 200 setup, can gains in banks and healthcare offset pressure from falling iron ore and energy prices today? What are we seeing there?
Look, it's going to have to. At this point in time, we saw a really late rally coming through on Wall Street, which helped to go and bump our futures into positive territory. But when you look at what's going on there, it's going to have to come down to the bank specifically, and potentially healthcare as well. CSL was down quite sharply yesterday. But when you look at the commodity side of the market, there is not a lot to go and cheer about right now. So if we're going to go and have a positive day on the ASX, it's got to be driven by the banks, which I've got to say at this point in time, from a technical perspective, still look pretty good. But from a fundamental perspective, where they sit in valuation terms, it simply does not make sense. It's really, really elevated compared to other banks around the world.
Well, let's get a technical outlook from you. What does the SPI futures break above the 50-day moving average mean for local market sentiment, if we can turn our attention to the home soil?
Yeah, that's where that does kind of a divergence between fundamental views and technical views really is seen. Because at this point in time, we've seen a break above the 50-day simple moving average in SPI futures, which is a pretty powerful signal. If you go back and look on the charts, it's actually gone and often respected that level. Now it's broken above it. It's every chance we could go and see a revisiting of the record highs that we hit earlier this year. A lot of people go and sit back and go, well, that doesn't make any sense given the environment we're talking about, trade uncertainty, economic uncertainty. But that's what the technical signals are right now. And until that goes and reverses back through, we get a clear signal saying, hey, this is wrong pricing. To me, it's still a buy and dips market.
Okay, so David, just to round out our conversation, I wouldn't be doing my job if I didn't touch on black gold. Oil prices, could Australian petrol prices be heading for another dip? And what's driving the MOGAS chart which you've provided us today?
Yeah, look, this is really interesting. So we've seen big declines coming through in crude up until the last couple of days. We did see a reversal last night. So this is the MOGAS 95 spot price. This is the Singapore benchmark price, and it's our benchmark price that we're going to look at for 91 octane petrol in Australia. So what we're going to pay at the pump. This is the wholesale price. And you can see there that it actually fell to levels last seen in the middle of 2021, earlier this week. Now, what that means for motorists is that rather than being around about 150, low 150s at the moment, which is the bottom of the price cycle, that could end up, if it holds around these levels, be around the top of the price cycle. So I'm talking about potential moves into the 140 cents per litre, or even potentially into the high 130s if it remains around these areas. Of course, that comes with a caveat that there's no price gouging, which of course we can't go and rule out in this particular marketplace.
Absolutely. I'll be sticking to my bicycle for the time being. David, thanks for your time on the program and giving us such a solid rundown.
Great to be here. Take care.